Hello, I am Karishma Gagwani from Cafemutual and welcome to Baat, Chit with Cafemutual. As we all know, financial advice has evolved over the years. But how has this evolution been like? And just like financial advice, investors' expectations have evolved too. To help you get answers to these questions, we have with us Amit Bivalkar, founder of Sapient Finserv Private Limited. Amit will share with us his rich experience that will help you manage the evolving investor expectations better. Hello, Amit.
Morning, Karishma, and thank you for inviting us to Cafe Mutual.
The pleasure is all ours, and thank you for being here. So, Amit, to begin with, how has financial advice evolved over the past decade?
Okay, not to get into regulations, but whether to use the word advice or not, I don't know. But what we have seen is that we have come from a long distance, as in we were a post office agent, then a PPF advisor, then a LIC agent, then we became fixed deposit brokers, then we became sub brokers, then we became mutual fund distributors. And today, what we are looking at is effective advice. So, what is more critical is that from an era of going and explaining the concept of mutual funds, now from a push, there is a pull onto mutual funds. So, now you have to have that challenge of how effective your advice is going to be. So, rather than giving out funds, I think we have moved to a solution based advice, and I think we should be actually known as a solution based advisor. So that's the major change what I see in the last 10 years.
Got it. Well said, indeed. Solution based advisor. Right. And since we're talking about solutions, investors' expectations have also evolved since the past few years now. So, how can an MFD or an RIA manage with these growing expectations?
I think it was a straight jacket formula 10 years ago. You had debt at 13-14%, and you had equities delivering 9-10% that time. So it was very straight jacketed that you could invest in debt and still get a 12-13-14% return because your inflation was very high. Cut to 2023, I think products have evolved. Clients' goals have changed. 15 years ago, you hardly will come across a client who will say, I want to have charity as my goal. I want to help the underprivileged children and all of this. I think it has all changed over the last 10 years. So the demand from the client side has changed not only for his goals, but also for products. And when we talk of products, it can be a product like a cryptocurrency, it can be a product of overseas investment, it can be a product like investing in art. And I think the MFD or the RIA has to upgrade himself in terms of knowledge on all of this. So you should exactly know what you should not do and that you should communicate to your clients. At the same time, what I feel is that we all have been taught over the last 10-15 years of doing product sales. It has to be the narrative, and according to the narrative, whichever product suits the narrative, that you should sell. We look at the product, write the narrative according to the product. It should be actually vice versa. You build a narrative, and whichever product suits, that should be advised.
So, talking about the narrative, in your view, what are those three must have fund categories in a portfolio of a retail investor?
Okay, when you say a retail investor, I'm assuming that's like a 5 lakh and below kind of portfolio. I think it should be very simple. They should have an allocation to debt, which can be a ultra short or a short term fund. If they have a 3 to 5 year view on the debt market, then a short term fund. Otherwise, you should be happy in ultra short if you have 1 year money. You should have a product like a ESF, which is a equity savings fund, which gives you a 15-20% exposure in equity. And when you graduate, I think you can go in for a balance advantage or a multi-asset fund. We generally try to look at the league tables and try to chase returns, which is happening right now with small caps. I think one should avoid for a retail investor over long periods of time. His expectation is, can he get a better return than a fixed deposit post tax? And I think that should be very simple. Do a ultra short or a short term fund, do a equity savings fund, and do a multi asset or a balance advantage fund.
Okay. Thank you for being with us today, Amit, and thank you for sharing your views on these.
Thank you so much.
And thank you everyone for joining us. Do stay tuned for the next episode. Until then, goodbye.